Started here. It's Jeff Scott. It is April 16th, 2017, 48 hours before tax time, as I'm doing this on Saturday, which is actually, I guess, the 15th, although I think we have to the 18th because of the holiday this year. I entitled today, Code Red, End of the Bull or a Bear Trap. Clearly, we're at a critical point in the market. I think everybody who listens to this is a trader to some sort, and therefore you already know that. My contact information is seen hgsidoc@gmail.com. I remind everybody I'm an unpaid volunteer. You don't have to agree with what I say. You don't have to like it, but you're not paying for it. So I'm going to continue to do them. And I respond to criticism, positive and negative. Fortunately, I hardly ever get negative criticism. But if you have negative or positive thoughts, please feel free to email me. Actually, that encourages me to keep going. Disclaimer, as always, is for educational purposes only. Anything I recommend or discuss in the spirit of education should not be considered investment advice. I'm a doctor, not a broker. I am truly independent. Every program I demonstrate, I paid for at some time in the past. And I don't get paid by anybody to talk positive or negative about any programs. And as you well know, trading involves risks, and you alone are solely responsible for any investment decisions you make. I like to think that my investment style is my own, and as I learned from Ian, who is really my favorite mentor, may he rest in peace, he used to tell us in his English accent, Jeffrey, I'm not a guru, I teach you to be your own guru. And I think every one of us should strive to become our own gurus, to learn from various sources and create the investing style that works for us, doesn't have to work for anybody else. Started with Canceling with O'Neill, improved with Morales and Catcher. Ian, working with George Roberts of HGSI Software, became my go-to vehicle when Telescan, which was a web-based or BBS-based program, went under in the around the turn of the century. And HGSI really was much of Ian's work was made to create tools in HGSI to mimic some of the scans and things that happened in IBD, even before we had investors.com. And then the software continues to improve and reflect various trading styles, not just growth. And Ron Brown, to the right of Ian, became Ian's partner from the live meeting perspective. And Ron has even built and had built into HGSI tools for volume spread analysis. And he's really done amazing things with that. This is my buddy George Lee. A couple times a year I have the luxury of sharing a podium with George. George is just a fantastic trader, good friend, nice, all-around nice guy. Over here is John Person. I learned a lot of fundamentals by learning Canceling and going to Ian meetings. But I think I really learned how to take trades and make trades by studying John. And John is a trader since I was a resident, owns his own brokerage. At one point, traded options on the floor in Chicago. He's an author. Two of his they're all good. Two of my favorite books of his are there. Teacher, mentor, software developer, and now a good friend. And then Van Tharp is position size and money management. If I had to pick the influences on my trading style, they're sitting on this page. I own a lot of programs. What I really need is a real-time platform. Like many, TradeStation it sits on my desktop, but I do most of my trading in thinkorswim. Thinkorswim has such an easy interface. But there are challenges with thinkorswim from some of the guru perspectives that if they develop indicators, it's very difficult to prevent them from being freely shared. So a lot of the people that develop for NinjaTrader or TradeStation don't develop for thinkorswim. And then I need analytic programs. I need HGSI and EdgeRater, and then supplementing with some websites and seasonality. Again, I am independent and a non-paid volunteer. But here's the website for highgrowthstock.com, and just the two things I always point out. One, free 30-day trial, doesn't even ask for a credit card. And number two, under investing strategies, you'll see some videos put together by myself and Ron Brown. Sorry about that, step away for a second. So again, under investing strategies, you'll find hundreds of webinars of how to use the program. I highly suggest that if you are interested in trying the program, you do your free trial, email me at hgsidoc@gmail.com, and I will send you some videos. Some of them are old and some are more recent that I think really will help accelerate your ability to use the program. Don't get turned off by the minimalist presentation when you double click on the icon. It's the most powerful program I have yet. If you didn't spend time to go pick up the hood, you wouldn't know the difference between it and being a Rolls Royce versus a than a 57 Chevy. So you need to look under the hood, and my videos will help you get there. Not that a 57 Chevy wouldn't be a lot of fun to play with. Stock patterns are cyclical. We really feel like we've started to hit and move over. And are we on the way down and beginning of at least a correction? Who knows? Certainly feels that way. Thursday was pretty significant, maybe too significant. Maybe we bounce before we go down further. But if you're not already starting to position your portfolio for protection or raising cash, you're probably late. And as I've looked at the market, it's time to raise cash, smaller positions, sell premium. I've been saying this for a couple of weeks. I still have plenty of longs, but many of them are collared. And I've had some naked puts on a couple of positions, and I've bought a number of contra ETFs. One of the things that I'm happy with on my short is I've got a short on SVXY. I personally like to short some of the more expensive of the ETFs when I think they're coming down, because if for example, SVXY, which will drop as VIX rises, to me has much better moves than VXX or UVXY or TVIX, and a lot of it's because it's a very expensive stock. So I'd rather either buy puts or short the expensive ones than mess around with the cheap ones. Of course, you could have the exact same return by just buying a lot more of the cheap ones. Hard to find a place to hide. Interestingly, biotech was one of the rare places of strength in the market on Thursday and during the week. But other than that, even utilities on Thursday were weak. The rest of healthcare was weak. Banks and energy are awful. Just a very, very difficult market to be long. I'll spend more time on this in a few minutes, but if you just look at the E-minis, the NQs, and the YMs, and the lower, so the futures on the S&P 500, the NASDAQ 100, and the Dow. Down here is the IWN because Thinkorswim stopped providing TFs. The VIX futures and the dollar futures. And now it's DXY with a dollar sign in front of it instead of the DX. Also a change at Thinkorswim. Just stand back and what do you see? I see on the four that are the indexes, I see a lot of red up top. That's not good. I see breakdown here below the 50, at the 50, diving below the 50, diving below the 50 and the 17. I see the VIX going up and the dollar struggling at the 50. I talked last week that although I thought we might get a pop to the upside, it looked like on Monday we may, that I thought we might come down and visit our 200s as my downside target. And I hope not, because I'm not short enough yet to get there. But that's kind of where it looks like right now. On the weeklies and the same patterns, you can see if you want to be bullish, here's the reason why you're bullish. You're still in great uptrends, and your weeklies are pretty much above the 17-day moving average, except for the Russell, which is sort of oscillating above and below. You can see on the weeklies that the VIX is still not very high, although it's definitely moved off its lows and can go much higher. And the dollar, although it's struggling here at the 17 weekly, it's at the higher end of the spectrum and not the lower end. And again, I like to look at the daily, these are by row, daily, weekly, and monthly, and columns would be E-minis, NQs, TFs, New York Stock Exchange, and the YMs. This is on Genesis. And the point of this is just you'll notice that everybody's on a daily sell. On a weekly sell signal, we now have the NASDAQ, the Russell, the NYSE, and the Dow. So the S&P is the lone holdout, at least on Trade Navigator. And then on the monthlies, we got a monthly sell signal on the Dow. Other than that, on the monthlies, we're still okay. So as the correction gets deeper, it's not surprising to see the weeklies go to a sell. We'll be watching the monthlies. Now, I've pointed out for weeks, I'm very nervous about rates and why they're falling. And I think that they sort of predicted that this market was going to be challenged because if the economy is doing well and the Fed's tightening, the dollar should be strong and rates should be going up. And neither of those last two are happening. If you look at the AD lines, I get and the small stocks on the left, the big stocks on the right, the S&P 500 is in yellow. So it's this white line which represents the AD. And it certainly looks like the small stocks are rolling over much worse than the larger stocks. They may just be preceding the larger stocks, and that's consistent with the weakness we saw in the Russell. Breadth decreased this week. It's still not near where we reverse. Usually when the breadth, either on stocks above the 200 or stocks above the 40 get down to the lower level, we see reversals. We've come down, but we are nowhere close to extremes. However, on the 13-week or 3-month new high, new low index, we are getting down to where reversal is usually seen. So thus far, I would say the market looks weak. Its breadth is being beaten down, but this is the only indicator so far that says a reversal could be close. So I think in this one, as you can see, the number of peaks and valleys, this one's sort of a short to intermediate term reversal. This tells me that I wouldn't be surprised to see a bounce, but I don't know if we're out of the woods yet. The McClellan broke down below the zero on the oscillator this week. And I think it's also, and it's been below the zero on the summation index, again, consistent with decreasing breadth in the market on both the daily and the weekly. The buckets, imagine taking all 1,500 stocks in the S&P 1,500, putting Bollinger Bands on them, and then putting them in piles. Over on the right, you put a pile of above or below the midline of the Bollinger Bands. You can see when 71% of the stocks in the S&P 1500 are sitting below the midline. The 3/12 date means that's when I created the index. And this was the date I ran it, which was the last trading day. So that's bearish. You can also see that 14% of the stocks in the S&P 1500 are actually below the lower Bollinger Band. Now, that's starting to get to reversal territory. So like the 13-week or 3-month new high, new low index, this is a second sign that we probably will have a bounce before too long. Not necessarily a recovery, and it could be a one-day or intraday wonder. We have not yet seen a Hindi on either the NYSE on the left or on the R3000 on the right. So since there has not been a major correction in decades that has occurred before the Hindi has fired, if you still want to be bullish, you can pat yourself on the back and say, hey, there's no Hindi, no worries. That doesn't mean we can't have a 4 to 7% correction, which is overdue. It just means we're probably not going to have the big whopper. Market tone, you could see on the bottom here on Friday, we flew a bunch of kahunas to the downside. And this is the Woody indicator, and you could see every index that we look at is red or in a sell signal. And then if you look at the sectors, almost all the sectors, except for, I think, healthcare, are red right now. I'd have to blow it up to see, but you could see it's broad spectrum weakness, and there's really no, quote, strength in the market. Well, then you want to take another check mark in the more bullish camp. Let's look at the canaries. You can see the stocks that make up the canaries. I create this index under the guidance and auspices of Ian, and it really was to give me a clue as to when this market was done, with the idea that the canaries might roll over before the rest of the market. The canaries are in a bull flag, I guess you might say. Up here, they're sitting on their 17-day moving average. Yes, they had a mobile breakdown this week. Their PSAR reversed. They had a pocket pivot to the downside. So there's a lot of things to say the canaries are done, but they're not done yet. So that's one thing that could go into the positive column and something that I'll be watching. Certainly if they break down and go below the 50, then I think this market is toast. Know your news and earnings dates. So on the left are some of the news. This is the economic calendar, which I copy from Bloomberg with the link down below. And they actually identify the things that be the most marking moving. Petroleum status report, jobless claims, PPI, final, consumer price index and retail sales and business inventories. And the green ones would be things that market may pay extra attention to. On the earnings dates, we're back. It's a big earnings season. If you own Netflix, it would be nice if you already positioned. I think they're, I'll have to look, see if it's before or after hours. I think it's after hours on Monday. But Netflix is the big one. We'll take a look at Netflix, perhaps if I remember, on the seasonality side. Banks, the rest of the banks, Bank of America and Goldman Sachs, even with some good results, banks sold off this week. CSX, trains, give you a sense of both trains, but also energy, and then Schlumberger, GE. So a very big weekend and a week of earnings. And then my comment, as always, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. We had a very painful week in the market. So this is a summary of the action from the end of day Friday to the end of day, in this case, Thursday. This window here looks at return over the week by ERG. ERG being EPS rank, relative strength rank, and group rank. You add them up to 3, since they each can be 0 to 99. You can get 297. And typically in a good market, high ERG stocks outperform. Well, the interesting thing is they underperformed. And in fact, relative strength rank, higher relative strength stocks did worse. Higher group rank stocks did worse. EPS was all over the place. And stocks that were, however, under accumulation on the following week actually outperformed. So how do I interpret this? I interpret this as a broad-based weakness and relative strength, and I'm a relative strength directed investor, wasn't working this week. On the right is sort of the group performance analysis. The things on the top that say 0, I had no stocks in those buckets, but these are a number of buckets, and I look at it every week. You know, I had a mediocre week, and I was down over 1%. But how did that compare to other things? I might look at my buy watch, which was down even more. I did not take a lot of buys. In fact, I started shorting and closing positions. So just because I own the stocks on Friday on the 7th, I may not still own them today. So this performance is sort of suspect in that way. But more importantly, I look at where the S&P 500 is. It was down 1.13, so I performed about the S&P. And interestingly, you could see that the IBD 50, the GIF All-Stars, some of my more aggressive scans are all sitting down here near the bottom and way underperformed the market. So not only was it a tough week, it was a tough week for growth stock investors. Thoughts. Wall worry builds as market sells off. Economic concerns drive dollar in the market lower. North Korea and France. North Korea with their missiles, France elections, along with a weakening dollar, drive gold up. Healthcare back on the table in Congress, which might delay discussions about infrastructure and tax relief. That's probably a big reason for the sell-off. Trump's moving to the middle. Not a surprise to me, but now he irritates the right as much as he irritates the left, driving down his approval ratings. Markets near key inflection points as key indices struggle to hold above the 50. Many past leaders are broken. Few industry groups are showing strength outside of healthcare, precious metal miners, and REITs. Yet the COT report, this is interesting, put this in the maybe it's not over yet category. It shows that the professionals are net long, although the data is from Tuesday. And as I pointed out, EPS season is in full tilt this week. Here's a commitment to trader report. In 2009, when the market was down, the yellow being individuals like us, the blue being the professionals, the hedge funds, as the market was falling, we were buying and the hedge funds were short. Right before the bottom, that flipped, the hedge funds went positive and we went negative. We stayed out of the market for the first 12 to 18 months of the recovery. Now we look at what's going on, and interestingly, the blue or the professional speculators, the hedge funds, is actually staying positive. Now, if the smart money thought this market was going to roll over. Don't you think that that would be expressed by put buying or flip to the bearish side by the professionals? I would. The problem is the report comes out on Friday, and it's only through the prior Tuesday's data, so maybe this week's will look different. Typical top-down agenda, and then based upon time, maybe some bottoms-up review. Before I even get into TradeStation today and look at my 5-point rules on what I think the market's doing, just open up Thinkorswim for a second and let's look at what's been going on in the market. So on all my charts, regardless of time frame, you're going to see a green and a red. The green is a 17-day simple moving average. The red is a 200 simple day moving average. On yellow on a black background or blue on a white background, you're going to see a 50-day simple. I'm a big fan of moving averages. Down here I've got on balance volume, because sometimes it's hard for me to understand what to do with traditional volume, but I see here that in yellow the on balance volume has dove below its moving average. And not only that, I suspect it's also dropped well, it's not exactly what I want to try that again, although I did want to bring it in closer. Trend line, so stop here and let's stop here. Now, it's traded below this trend line. That was just the point that this trend line is going to continue up. The interesting thing, I think, on this market is how many dojis we had, or doji-like narrow range bars we had for day after day after day. And it was interesting because we were range bound in between the 17-day moving average and the 50. And on Wednesday, we broke and we closed below the 50. On Thursday, we got worse and we broke below our moving average strongly on the moving average on Monday. I think this market is showing some dangerous signals here, and I, for one, am concerned that this big run-up that we've seen is coming to an end. So this is the E-minis broken below its moving averages, OBV falling. I look at the NASDAQ, not as bad. It's sitting right on the 50, OBV dropping. You notice up here I have a number of things. I have some volume things, but more importantly, one-day change, forces are both red, pocket pivot to the downside, looking for kahunas. We had a kahuna to the downside. Excuse me, no kahuna rather, it'd be red or green if there was. We're in a squeeze and the Bongo Daily is red. So I could see a lot of things on this chart. NASDAQ looks a little bit better because it hasn't really broken the 50. That may happen this week. And the YM PPS sell signal has broken. You can see how much the OBV has broken down here. The YM is broken below the 50 and the 17. The VX has had a nice up move in a doji on Friday. If this market is done falling, the VX will come back down. If we're in the midst of a bigger correction, I expect the VX to launch. And you look at where the VX has come from. The VX could have a long ways to run. And the dollar would be interesting to see if the dollar can regain the 50 or is it going back down to the 200. So I do that review on a daily basis. And in my bigger monitors, it doesn't look as jumbled up with a higher resolution. Let's just very quickly look at TradeStation. So let's go into my screening view. Actually, that's not what I want. I'm going to go into my, never mind, my market force and divergence. So I do 5 points. I look at every index. E-minis, I look, number one, is there a red or green arrow? That's a PPS sell signal. This is the daily. It's in a sell signal on the weekly, still on a buy on the monthly. Then I look at the color of the paint bar. That's an elder impulse indicator. The arrow is a person pivot, a PPS buy signal, sell signal. The red paint bar tells me that I should not be going long. It's red on the daily, blue on the weekly, and looks like it's gone to blue on the monthly. Third thing I look at is where am I within the envelope, knowing that when stocks get above their envelope, they tend to come back in. Fourth thing, I'm looking for any evidence of divergences, which are these red dots here. You can notice the weekly divergence worked its way out. And then the fifth thing, I look to see if we're extended. This is extended. This is not extended. We're at 33% of the highest extended we've been all year. So looking at the E-minis, we're in clearly a sell signal on the short intermediate. Looks pretty weak. Nothing to get bullish or excited about on this chart. If I look at the YMs, sticking with the big, a new sell signal came in on the YMs, at least in TradeStation on Thursday. You can see how much high jump has dropped. We're red here. We're in a sell on weekly. Looks a lot like the E-minis, except it took longer for the sell signal to come in. On the NASDAQ, again, this is the NASDAQ 100 where most of the action is. Again, broken record, sell signal, and red paint bar. Very weak on the short term. Now, interestingly, the NASDAQ is still in a weekly buy and a monthly buy. Notice these red dots, and then the bar is turning blue. So you're getting some evidence of divergence and reducing power to the upside on the weekly. And lastly, if we look at the Russell, you can see the Russell's in a sell signal daily and weekly. Hard to get bullish on any of these indices, at least where they sit right now. The dollar, still in a buy signal on the daily, but in a sell signal on the weekly and a buy on the monthly. I'm more concerned with that red paint bar. If this dollar doesn't get above that purple or magenta line quickly, we'll probably trigger a sell signal to the downside on the dollar. And although that might be good for oil and gold, it's probably not good for much of the economy. And then speaking of gold, you can see gold has had a nice run. It's in a sell signal. First thing in a sell signal we've looked at, in a buy signal rather, green with a buy, green with a buy, green. So all 3 time frames now, gold is in a buy signal. I look at the VIX, also in a buy signal, although notice how far it's out of its envelope. Under normal circumstances, I'd expect this to come back this week. It probably will, but if there's a deeper correction in our future, it will probably quickly go back higher. And then oil, I think I have that somewhere. Oil's had a run up to 53. I thought I saw it over the weekend or after hours trade down some. Oil is in a buy signal, but the blue paint bar is bothersome, and it's in a buy on the weekly, so oil has been stronger. Shut this down for a second. See what the sports news was. Nothing. Now let's go into HGSI and take a look using additional tools of the strength of the market. So I like to open up my warehouse view, go down to Woodward and Brown user groups, which is included, and look at Major Markets Plus, and then change this to a T top-down view. And this is for a top-down investor. It's going to show me where the strength in the market is by ranking it by raw combo. And it gives me a sense, if I know my combo, of what's going on in the market. And this combo is going to heavily weight for the last trading day, which in this case was Thursday. A little bit weight to the last week, just a teeny weight to the last 3 weeks. So if you lost money this week, and I lost some this week, it's no shocker. NASDAQ, SP 500, the 1500, the 100, the 2000, the 600, the NYSE, the mid-caps, and the transports all make up the bottom. So all the major indexes are in the lower half of this ranking. Let's look at some of them. So I'm going to go back to a cleaner view, and I'll add a couple things to my view. And the top, I have my bongos. The bongos are something that I was involved in developing. They are not fast, at least the weekly is a slow timing indicator, but it's a pretty good buy-sell indicator. If you accept it, you get in a little slow. The weekly indicator is very quick, perhaps too quick. I don't like to be long when the weekly bongo for the major indexes is red. Same token, I don't like to be short as long as it's green. So the next two bars, so that's a weekly on top and then the daily. And then in the setting of an uptrend, the long term stays green. And when the short term goes red, it's usually during periods of pullback. So it's a way to find stocks that are pulling back. The next two bars are two different calculations of the Hindenburg. I am a fan of the Hindenburg. I've been a fan since I learned about it from Ian years ago. And the reason why I like the Hindenburg is because I was trading in 2007 and my bacon got saved the second time around. The first time I watched it and shook my head and said, what does this mean? When, that's 05. So early 07, the first half, we had a bunch of Hindenburgs. I got out, but I got out a little late. Pretty good correction. Then we returned to new highs, and I shorted these and got out of the market. And that was a good thing because that was all she wrote. So notice the Hindenburgs and then the weekly bongo turning red sort of preceded the big market sell-off. And Ian really was great in teaching us things like the Hindenburg. So no omens there. You can see I knifed through the S&P 500. So really the only data that I added was, or learned from this, is my bongo went bearish. So that's one in the bear column. I put these lines in here last week as sort of my targets. So my first target is not much below where we're at, a little bit below where we're at. My concern is, if we're in a true correction, is there another 90 points or so to get us down to the 200-day moving average? Not a big deal. 90 points, that's another 4%. Under normal times, that's not very much at all, but it'll hurt a lot of portfolios, that's for sure. That's the S&P. If I take a look at the Dow Jones, kind of looks the same, also in a weekly sell. If I look at the NASDAQ composite, again, the same pattern. Now the NASDAQ 100, which is just the big stocks, is sitting right on the 50 and looks more like the NQ futures. And then if I look at the Russell 2000, also weak. And this is what happens. On the way up, this 50-day moving average was great support. Now that we've broken below it, it may turn out to be staunch resistance. So until I break above that 50, I will be suspect on the Russell and the other moving averages. And again, red on the weekly bongo. The dollar, which had been in a uptrend and now been sideways, is still sideways, trapped between the 17 and the 50. The VIX is in a nice little uptrend, but perhaps it's run too fast, too quick. And if there's any pullback this week, then, or any abatement of the bearish tone in an up move this week, then the VIX will pull back. However, we have to be on guard for this, because when this VIX takes off like this, you lose money if you're long, and when it turns is when you want to get real long, because you make all your money when the VIX falls back. No shocker, gold is up at the top. What's interesting is gold looks a whole lot different than miners. I know it's right in front of me. Miners are stuck below the 50, and then silver looks different again, kind of looks like gold. So miners have a ways to go. Notice silver is green on the weekly bongo. Gold is green on the weekly bongos. And miners just recently turned green. So gold may be working. There's issues with JNUG in that they're having challenges keeping up with demand because there's not that many small gold miners left, enough shares of them. And so I'm going to play mostly Nugget and maybe some individual names if I'm ready to play the miners. So now I've got a sense that the market is weak. I mentioned that biotech was holding up better than others, and it's not great, and it too is below the 50-day moving average, but the bongo remains in green. Next thing I do is I drop down to my industry group rotation, and you can see I have 172 groups. And then I want to look at short-term momentum, so I look at the 2-day force, and I could see that positive momentum over the last couple of days is two things: healthcare and precious metals. If I expand this out to 5 days, I bring in the REITs and the telecoms and the home builders, and a bunch of utilities. And tobacco. What do many of them have in common? Dividend payers. And as the interest rates is falling, I think it's making some of these dividend payers perhaps more attractive. If I look to the downside, there's not that many to the downside, only 17 groups short term. Home builders actually flip to the downside, and intermediate on the downside, you could see on a 5-day window, we've got 70. So let's go back and look at the groups that are going to the upside. Right click on the index, change index group. Let's take a look at the first one. Now, the first one, I'm going to add the rest of my indicators. If you don't know what they are, email me and I'll send you the video. On the surface, this is Insight. This looks great. Had an upgrade last week. It's in a weekly bongo green, mobile breakout from a squeeze. It's about to have a PSAR reversal. It's above its 50 and above its 17. Had a pocket pivot on Thursday. The problem with Insight is a problem with biotech. Its earnings are out May 4th. Everybody knows that. ASCO, and it's a cancer mostly company, is in June. First weekend of June. Everybody knows that. But it turns out on Friday, the FDA announced that a drug that is being brought to market by Eli Lilly, which is supposed to be a blockbuster, which is an Insight drug, which means they get royalties, got turned down. So this company may be under pressure, at least at the beginning on Monday on that. And the reason why it's a challenge for me is I had no idea that was coming. If I knew there was a presentation or an earnings things, I would have been more positioned. Gilead or somebody may use any weakness and Insight to use it as a takeover. They're not going to sell for less than 160, but if they get taken down to 120, they'd probably be much more likely willing to sell the company. But we'll see. I've been expecting Gilead to make a move on them. I have no inside information on that. It just is the best oncology asset that's currently available. Alexion, hard to get excited here. It did have a great day on Friday, but it's in a downtrend. I like buying stocks in an uptrend. This one's interesting, Ionis. I don't own it. Its name is Ionis. It's in a downtrend or sideways. The weekly bongo's red, but it had a mobile breakout squeeze, a pocket pivot, and a kahuna, and a big move off of the 200-day moving average. You could certainly buy this if it trades above the open or above the 50, putting your stop below the 200. It might be a little wide, but this one looks like it wants to go higher. Clovis, pretty steep pullback. They've got an approved drug recently on the market for ovarian cancer, competes with Tesaro and AstraZeneca. Pull back pretty hard. Not sure I'm going to jump into this one. It's also a potential takeover candidate. Kite has a new type of cancer therapy called CAR-T, which they'll be the first to come to market, barring other issues. I have a position in this one. It had a mobile breakout from a squeeze, a pocket pivot, and kahuna end of the week. It's at the high of its range. It's got, excuse me, I don't know why I'm yawning. It's got at least a double top it's got to get through here. So I'm not adding to it. I'm watching it closely. They are up for an approval perhaps later this year. They'll be the first with this new innovative therapy. Biogen IDEC, sideways now for months, 8 months. Had a kahuna and a big green day on Friday. Still don't know where it's going. Tesaro, I mentioned, competes with Clovis's drug, another darling of Wall Street, and another one potential takeover candidate. It's pretty deep in its pattern. Gilead, the one that everybody likes to talk about in all takeovers. Why? Because they've got great revenue. They just don't have any growth, and they've done an amazing job in changing outcomes in hepatitis C and in HIV, but they need growth, and Wall Street wants them to grow, and they're going to have to grow by acquisition. So Gilead Clovis, Gilead for Insight, Gilead for Tesaro are often talked about, and hence those names look better. Regeneron, below the 200, I would pass on that one. Exelixis, another one in a sideways pullback, also had a mobile breakout squeeze and a kahuna on Friday. I don't like the fact that the weekly bongo is still red, but this is another one that has a good story and is also a potential takeover candidate. All right, that was biotech. Notice how many of them are cancer related. I have to be careful what I say on companies I work with, but on those that I don't work with, then I feel very comfortable saying a lot. Neurochem Bioscience. I always have to be careful. It's not that I would say something wrong, but if I'm privy to any inside information. So I will tell you that I have done work with Insight from time to time. Everybody who reads anything in Wall Street knows that they're one of the targets for Gilead. That's where that comes from, not from any inside information. No one would ever tell you that anyways, if you asked. Neurocrine Biosciences had a drug approval. This is what happens when you get good FDA news. I don't know enough about this company or the space that the drug was approved. Interesting, you see it had a Bible gap up on Thursday and a nice day on Friday. Mobile breakup from a squeeze and a kahuna off of the 200. You know, sometimes I just say it's a great story. They got a drug approval coming. I look at what the market cap is, not the stock price. The market cap's $4.6 billion. Does it become an attractive takeout candidate? I don't know. Sometimes I'll take a junior position on this Bible gap up so I have a stake at the table and then see what happens. It wouldn't surprise me if something moves because of the approval. Axovenant Sciences, they moved up on news that wasn't earnings related, but a big gap up continues to run higher. Again, the same story as Neurocrine. Sometimes it's hard to pass up participating on these, but you got to be careful. If and when I'll show you Esperon in a second. It's one that ran up like that, pulled back, set a new base, and I think will go higher. You don't want to be the last one buying before it pulls back. La Jolla, pretty deep pullback below the 50. I'm not ready. Acorn, this is a well-described on the outside takeover of Fresenius for Acorn, not announced yet. So everybody expects it to happen. If it happens, it might be at a take under price. It's had a big move. Or it might be at a small premium, or it doesn't take over and the stock can fall. I would not be chasing this. The price is probably already priced in. And here is Aspirion. You know, you think back to some of those stocks I showed you that had the big gap ups and the big moves. And Aspirion certainly did as well. And one could have argued that a $13 stock, that you would not want to buy that at 17. And I actually bought it the next day because I didn't pick it up that day, and I got in at 18. And that was clearly extended. You can see the high jumps up at the top, but it got even more extended. It ran all the way up to 40-ish, 45. And then it had its reversal day with a market reversing as well. That's what this is, a Phoenix. And then you can see that it's come down since then. So now it looks like it wants to go higher again. So I'm still long Esperon. I chased it up. I sold some calls up at the top and kept some of my cheap calls. But I did take profits because I've learned the hard way. You better take profits on the way up. Conidas breaking out here. Don't know anything about it. Nice looking breakout here, a little bit more orderly. Cheap stock if you want to play in this arena. So several of these specialty pharma companies look interesting. Precious metal and mining. It's going to be start with some silver stocks. Mostly small stocks are the leaders here. which is interesting. Hecla Mining, sort of a sideways pattern here. For a little bit under 5% of the shares are in the float are short. Broke above the 200. Everything is green up here. It's in the right sector. This is going to move not on individual name news, but on the price of the dollar and gold. Pan American Silver breaking out above its moving averages. SBGL. Probably wouldn't be buying this one as it's below the 200-day moving average, which I think could be resistance. Tahoe Resources. Most of these are small companies. Some of the big guys, American Barracks and Royal Gold. We'll look at in Gold Core. Here is Royal Gold breaking above the 200 in a nice short-term uptrend. Everything is green. American Barracks. I was reading somewhere that they're going to have a lot of leverage going forward because of some cost reductions and other things that they've been doing. Looks like Royal Gold. And I bet GG looks the same way. Not quite as good. I think it's probably not a bad idea to consider owning some metals, but I'd also be aware that if the dollar comes back up and this Korean thing abates and the French election doesn't go to the right winger, dollar's going to go back up and gold may be coming down. I typically go through the top 10 groups here. There's only 5. Medical devices, look at a couple of them. Not great charts if I remember correctly. This one not too bad. Maser Robotics pulled back to the 17. Looks like it wants to go again. Doesn't make any money. Edwards Life Sciences had been a big winner, kind of sideways in dead money right now. Pulse Biosciences, here's that pattern. Big run up, shake out, pull back. Got to get above the 17 before I would consider it, but I'm going to be having that on my watch list. Globus, a little bit more steady move up after it crossed over the 200. Up near the top of its high jump, so higher risk. And then beat another nice, relatively tight pattern from this bottom in November to where we are today. And then lastly, healthcare services. No idea what China cord blood does. I could guess. I don't know if they do harvesting for transplants or what they use it for. They create cells for lab work, but you could see a huge, what do we call this day? Belt hold, where not only is it an engulfing day, it really takes out the entire 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. It's about 11 days worth are held on this. It opened here, traded down, and closed at the high of the day. With the Kahuna, great OBV, doesn't make money. It's probably worth a little bit of my own research. I think they own senior living. What do they do? This is a placement service for healthcare professionals. It's really done nothing for months. I would pass on AMN. Air Methods, Air Ambulance is a takeover. Quintilis is research, and Teladoc is pulling back to the 17-day moving average. So I haven't shown you a lot of great charts. I haven't jumped up and down and said to go long. And the reason for that is there's a lot more activity to the downside. Now, I actually did look at a lot of shorts. So let me just go back and review my process with you a little bit. I start the week, or all week long, I start saving watch lists. And these watch lists occur online. I get emails. And I basically capture a bunch of different lists, some from MarketSmith, some from investors.com. I have my own scans in HGSI that I like to run, the smart groups in HGSI, bar chart, among others. And then I basically take all these scans that I collect and I dump them into one bucket, which is this consolidated buys. And then I restrict them on price and volume, which was $5 and 250,000, although I don't buy a lot less than 500,000. And then I look at every one of those. It was about 500 this week that I looked at. On the short side, I do a similar thing, And I also add some trade station scans, which I'll show you in a second. And on the short side this week, on the weekend bears, I had 800 stocks. And then I put a filter on them, and I got down to 382. And then, basically, after all my work, I came up with two lists. I came up with a buy list, and let's talk about some of these. Many of these we've already seen. Let's just put no filter here and put them by industry group. Heavy in biotech, heavy in REITs. The mortgage finance stocks have great dividends and specialty pharma. So my buy watch list, even though this came from a lot of bottoms-up review, is very much tied to the groups that were at the top of my group strength. I break them down into subsets. So, for example, pullback ready to run. These are some of my favorite stocks. And let's look at one that would be bullish and one that reflects bearish of the market. We've looked at many of these. So AMAG Pharmaceuticals. Now, I apologize if this comes out wrong to any of the women on the phone or on the video. AMAG, if I put a weekly, you could see AMAG has had a rather rough, here's my favorite pattern, then a little bit over here, has had a really rough go of it of late. And that's because they're a critical product which helps prevent premature births in high-risk pregnancies, has very little patent protection after this year. They're trying to get more, but assume it to say the market is discounting its value going forward. Then, on this date here, let's go back to daily. They had an earnings shortfall. And then a couple days later, they're sitting at JP Morgan, probably around that date there, and they announced that they just licensed a new drug. That new drug is, they're going to call it the female Viagra. But what it really is it's to stimulate desire in females. Again, not to be crude, rude, disgusting, but there's probably a market, at least us men hope there's a market for women who to take this medicine. They are gearing up for an FDA opinion. My guess is this move on Friday with a pocket pivot, a kahuna, a Mobo breakout from a squeeze, although still in a downtrend on the weekly bongo, may be something to pay attention to. If I go into TradeStation and I go into my screener, I'll find out that it had some things I like a lot about it. AMAG, my wife just walked in. It's a good thing she didn't hear what I was saying. AMAG had a weekly high close doji, had a weekly person buy signal come in. Its OBV is breaking above its moving average. On the daily and the weekly, it had a high close doji. It's in a daily buy. This is a relative strength tool that person came out with, which just went to positive on both the daily and the VM indicator on the weekly went positive. This looks beautiful, except for the bongo. It might be someplace to play, and you saw that it's in a strong group, the specialty pharmacy group. So that was one that I liked. Again, it's all about the female libido pill. The bad news is, if I look at the ultra-short S&P 500 Pro shares, I also see something I like. Break above the 50, a PSAR reversal, pocket pivots, kahuna, out of a squeeze, and the weekly bongo turned green. If that was a stock that was long, I'd be all excited by this. When I start to see the Pro shares on the Dow shorts and the S&P and the semiconductors all look weak, that doesn't say a lot of positive for the market, and they made my buy list. Anything else here that I thought was so good you had to buy it? on Monday. And believe me, there is no thing that's so good you have to buy it on Monday. On EdgeRater, it showed pretty good seasonality for TAL, TAL Education Group. I've never made money trading these stocks, so I don't trade them very often. Obviously, I've missed a huge run-up. So I see here a number of different things. I see a Morningstar candle. I see a kahuna. I see a squeeze, and I suspect that might be considered a high-close doji. It depends if we consider it an uptrend or a downtrend. Short-term downtrend and a high-close doji, but it's been in a long term. So this is TAL. Let's go back here. So we had a high-close doji on Friday. It's been a big mover. It has had a pullback. I would feel like I'm chasing it. I don't see a lot of earnings power, but I did see some seasonality. So what I typically do then, EdgeRater is probably a little simpler on the seasonality, but it's included in a program that is cheaper than any of the seasonality programs. And to me, seasonality in EdgeRater is a bonus. It's not the only reason why you buy the program, but it's included at the same price as all the other great tools that I use it for. So let's just use Seasonality Trader today. Could have used Best Choice or Magenta. And let's put in TAL. Whoops. Helps if I include the T. So I see we're in the midst of a pretty big run, which is green. Let me put, so we're in a pretty strong uptrend. We're at the bottom of the channel, which I like a lot. And it shows me, at least here, the positive season started a few days ago, but it's in a range between, I did this again. All right, we got to redo this. Here's a sizing thing. I have a sizing thing. Between March 31st and May 16th, it's up 8 out of 10 years, positive 11.4%. These are in yellow, the 10-year line, and green, the 5-year line. They certainly go up until the middle of May. So it does look like there's positive seasonality here. The other one I wanted to look at was Netflix. And let's set Netflix on an earnings because it's quarterly earnings, and let's the earnings. No, why is that doing that? 1 second. Okay. What do you think Netflix is likely to do with this earnings announcement? This tells me, and then the earnings are Monday, between April 18th and May 29th, it's up 9 out of 10 years with a 28.7% return. So let's just take a look at where we are in the channel. I don't know if I did that right. I don't use this computer very often, so a lot of times my stuff is not set up well on it. So here we are at the bottom of a channel. The channel's heading up. We're going to a seasonally strong period of time. You can see the move the day after earnings. Earnings are going to come out here after hours, I suspect, and this is day 2. You can see it's almost always green. I think Netflix is in a positive time to buy it from an earnings perspective. It's at the bottom of the channel. I'm holding it into earnings just because I already have some, and TAL I'm going to look at as well. I did mention that I did look at stocks to short, and these were some of the zillions of shorting candidates that I saw. Rather than buy some of those cheap contras, I'd rather short expensive ones. So, for example, rather than buy dog, I'd rather short the diamonds. You can see the volume on these. Obviously, it's a much more expensive thing to short versus the dog. Which is an $18 instrument. If I get a 10% move in the dog, I move up $1.83. If I get a 10% move in the diamonds, it's a $20 move. Some of the things that really looked interesting from a shorting perspective. Energy, I don't know. I just looked at Devon Energy and I see a stock that broke through the 200 and it failed at the 50 and 200 trying to get above. I think it's going to go back down here and test this low. So I thought that was an interesting short. M&T Bank's already heading down. Seacoast Bank is a cheap bank that looks like it's breaking down. Low close doji here. A mobile breakdown in a weekly bongo red. Take a look at Anthem. Another, it hasn't broken down yet. But when I went and looked at it under TradeStation, and let's go to the Anthem here. I thought I had it in here. I saw a stock on the monthly that's going sideways. It's in a sell signal weekly. Had a low close doji and a sell signal on the daily. Volume is broken down. Maybe too early, but Anthem looks weak, as do some of the other insurers. Rockwell Automation, is another one that looks like it's potentially shortable, and you can see it's breaking down. My target would be the 200-day moving average. On these, I might be buying puts, and what I'd probably do today is I would sell a call spread, maybe a 155, 160 call spread. That's a trade if I think the stock's going down, low risk trade. And I might take the proceeds from that and I might buy a 150 put. And that way, if the stock drops, I make money on both ends. If the stock goes up, I paid for the put with the call, although I have risk on the call spread. And typically the way I manage that is if the stock drops, like it may if the market rolls over, I'll close out the call spread and when I get 60 or 70% of the profits in it, and then just let the put ride. So I'm going to be looking to both the long and the short side, probably a lot more to the short side. And if I buy longs, they'll probably be contra ETFs. So if I bought, for example, SDS, I was taking a long position. Looks like it's breaking out there. Everything's green out of the squeeze. But all the SDS is the same as shorting at a lot less dollars, the spider, which will be the exact opposite. So I could either buy a contra ETF or short the underlying. Hope you guys got something out of this. It was lengthy as usual. I appreciate the feedback. Positive or negative. And I guess one more thing, if you made it this far. You might notice I have a lot of indicators here. This is my secret weapon. This is how I merge TradeStation with HGSI. And I had them done for me. It's my Kahunas, Pocket Pivots, Bible Gap Up, Squeeze, Mobos, among others. And I put them into dots. I don't sell them. When I used to have live meetings, I would offer indicator packages or include them at no charge. But since I've gone back to work, I'm not doing live meetings either. So I'm going to offer a special, a really special deal. If you're already going to John Person's meeting, it counts too. John Person, my friend,
Hi, John Person.
Hey, John, how you doing? Has a seminar coming up in Vegas. I will be there. In fact, my wife will be there too, which is going to be especially fun. She wonders why I always go to these things, because I've been to them several times. And I tell her it's the same thing I learn every time, and John's brilliant. If you go to personsplanet.com, and just to go back to that, you go to events, seminars, it'll bring you to this upcoming meeting. If you attend this meeting and you come up to me and you say, Jeff, I saw your video, give me my freebies. Here's what I'm going to give you. If you're not already signed up for this meeting, sign up for it and tell Mary you signed up because you heard my offer. She won't know anything about the offer, but I'll take care of you at the meeting. And the offer is anybody that comes up to me at John's meeting and asks, I will give them at no charge my Jeffrey dots with an explanation of how I integrate them with John Person's great tools. And I'll also, you'll have to pay a third party for a multi-time indicator, but I've also hard-coded the bongos. And I will make those available at no cost to anybody attending John's meeting. And if you are going to sign up because of that, please make a comment to Mary. So give me a little extra credit there. Not that I get anything except wanting to help them. And then if you have interest in my Thinkorswim indicators, if you're attending John's meeting, I'll share them with you as well. So on that note, go back to John's website. So I just pump it one more time. It's a great deal at $14.97. It's 3 days, including in the market. I go there all the time, and I will continue to see him because, again, I learn every time. Hope to see you there. Y'all have a great week. Be careful, and for those of you celebrating, have a happy Easter. Good night, everybody.